If you're over 50 and you're quietly wondering, what if everything goes wrong again, like 2008 or worse, this episode is for you. Think back to the last big scare that really shook you. Maybe it was the 2008 financial crisis. Maybe it was the inflation we've just lived through. Maybe it was losing a job or watching your 401k get cut in half. Whatever it was, you know in your gut that the world is not as stable as we'd like it to be. History has seen currencies collapse, stock markets crash, and housing booms turn into disasters. Retirees in the Great Depression watched banks fail. People in other countries have seen their money become almost worthless in a few months. But in all of those storms, certain kinds of assets have consistently held value or bounced back faster than others. The danger in a real crisis isn't just losing money on paper. It's losing your purchasing power so your dollars don't buy much. It's losing your home because you can't make payments. It's being forced to sell good assets at the worst possible time just to keep the lights on. Pause. That's the part that keeps a lot of people up at night, even if they don't say it out loud. In this episode, we're going to walk through 8 types of assets that have historically survived serious economic stress, from the Great Depression to hyperinflations overseas to the 2008 crisis, and what a normal retiree can realistically do about it. These are not magic bullets, but they are things that have given real families a fighting chance when times were ugly. If you knew which kinds of assets tend to hold up when everything else is falling apart, would you structure your retirement a little differently? Some of these are things you can invest in. And here's the twist. Some of the most powerful assets are not things your broker can sell you at all. Let's start by getting clear on what economic collapse really means and what it doesn't mean. Welcome to George Edward Explains. I'm George, and here we talk calmly and clearly about money, retirement, and the decisions that actually affect your daily life. Today we are not predicting the end of the world. I'm too old and too honest to play that game. What we are doing is looking at history, at times when economies were under extreme stress, and asking a simple question: what actually held up? What helped real people get through? This is education, not personal financial advice. I don't know your full situation. Before you make big changes to your investments or your life, talk with a qualified financial professional who can look at your whole picture. All right. First, let's define what we mean by economic collapse in a way that matters to you and me. When I say economic collapse, I'm not talking about every little recession or a bad year in the stock market. I'm talking about periods where big things break, times when currencies lost a lot of value quickly, when stock markets crashed and took years to claw their way back, when unemployment spiked so high you could feel it on every street, when governments changed rules overnight because they were desperate. Think of the Great Depression in the United States. Picture those black and white photos in your mind, men in lines for soup, families losing farms because they couldn't pay the bank, people stuffing cash in mattresses because they no longer trusted banks. Think about the 1970s, stagflation. Prices rising fast, gas lines, ordinary wages not keeping up. Your paycheck was the same number, but the grocery cart had less and less in it. More recently, the 2008 financial crisis. House prices tumbling, major banks and Wall Street firms on the edge, millions of people losing jobs. I remember people opening their retirement statements and seeing 40% or 50% gone, on paper at least. Some stopped opening the envelopes. They just threw them in a drawer because they couldn't stand to look. Then think about more extreme situations outside the U.S., places where inflation ran wild, where people needed bags of money for groceries, or where a government suddenly froze bank accounts. You may have seen those stories on the news and thought, that could never happen here. Maybe, maybe not. But ignoring the possibility is not a plan. For normal retirees, an economic collapse doesn't have to be the end of the dollar or a total breakdown of society. It can be something as simple and as painful as this. Your investments drop by half, your house falls in value, prices at the store jump, and suddenly your careful plan doesn't work the way you expected. Do you remember how you felt in 2008 opening your statements, or maybe avoiding opening them? Do you remember thinking, I thought I was safer than this? In each of those storms, some assets got destroyed. Companies went bankrupt, some houses were lost, some currencies never recovered, but some things quietly held their ground or even came out stronger on the other side. That's what we're going to focus on now. Let's start with the most basic human need, food and shelter. Asset number 1, food production. Productive land. In every crisis, people still need to eat. No matter what happens to the stock market, no matter what happens to the latest technology trend, stomachs still growl. Land that can reliably grow food has historically kept real value, even when currencies and paper assets went crazy. Now, most retirees are not going to go out and buy a big farm and run tractors at age 68, but think of food production as an asset class. In some past crises, people who owned productive farmland, or who had rights to a share of that production, had something solid. They could feed themselves. They could trade food when money was shaky. In more modern times, people sometimes have exposure to farmland through investment vehicles, funds, or trusts that own farmland and lease it to farmers. You don't have to get fancy. Even on a small scale, having the knowledge and ability to grow some of your own food, gardening, a small plot in the backyard, a few raised beds, can be a small form of resilience. If your income got squeezed, would you feel better knowing you can at least put some food on the table from your own land or your own skills? I certainly would. Asset number 2. A modest, paid-off primary home. In deep downturns, yes, home prices can fall. Yes, housing bubbles can burst, as we saw in 2008. But there is a big difference between someone who owns their home free and clear and someone who owes the bank 90% of its value. If you have a modest, paid-off home, you remove one of your biggest monthly expenses. You are not worrying about a mortgage payment every month when your portfolio is down or your hours got cut. You can ride out storms without a bank knocking on your door. A big fancy house with a giant mortgage is a different story. I'm talking about a manageable home that fits your budget and your needs. I remember a man I knew who lost his job in the early 80s when interest rates were sky high and the economy was wobbly. He was scared, but he told me, "George, at least the house is paid for. We may have to eat beans for a while, but the bank can't take our roof." That security changed everything about how he handled that season. Those two, food and shelter, are the foundation. If you can eat and you have a roof no one can easily take, you're already ahead of many in a crisis. But what about your actual money, the stuff in accounts and statements? Asset number 3, cash and short-term reserves in a solid currency. In some crises, cash is king. Picture 2008. As stocks and real estate fell, the people who had safe liquid cash could buy what everyone else was desperate to sell. They could choose to buy bargains or simply survive without dumping their own assets at fire sale prices. Now there's a twist. In other kinds of crises, especially inflationary ones, too much cash for too long gets eaten alive. If prices are shooting up, a dollar that sits in a checking account for 5 years can quietly lose a lot of its buying power. So the point is not all cash all the time. The point is to have enough safe, short-term reserves, emergency savings, plus some dry powder in safe instruments like short-term CDs, treasury bills, or money market funds, so that if the market falls 30 or 40%, you don't have to sell your stocks or your house at the bottom just to pay the bills. If the market fell 40% tomorrow, would you have enough safe cash set aside to avoid selling at the worst possible moment? Or would you be forced to sell something you'd rather keep, just to buy groceries? That's the question cash answers. Asset number 4, precious metals, gold and silver. For thousands of years, in times of war, inflation, and currency collapse, people have turned to gold and silver as stores of value. When paper money became worthless or distrusted, metals often still held buying power. I've heard stories from families who left countries in turmoil with nothing but a few pieces of gold sewn into clothing. And that's what got them started in a new place. But let's be honest about metals. Their prices can swing wildly. They do not pay income. You can have years where gold goes nowhere. They are not a magic solution that makes you rich in every scenario. They are more like an insurance policy against certain kinds of disasters. For some retirees, having a modest slice of their net worth in physical precious metals or funds that own them can be a psychological and practical comfort. Not 90% of your money, probably not even 20%. Just enough that if you woke up and the headlines were truly bad, you'd know that not everything you own depends on the same set of promises. Metals can shine when paper burns, but they're not the only survivors. Some very plain-looking paper assets have also come back from the dead after past crashes. Asset number 5, shares in strong, essential businesses, often owned through broad index funds. In deep market crashes, stock prices can get crushed. I watched it in 2000 with the tech bust. I watched it in 2008 with financials and housing. I've seen people swear off stocks forever. But here's what most people don't realize. Not all businesses die in a crash. Companies that sell essentials, food, energy, healthcare, basic services, often survive, adapt, and later thrive. If you think back over your lifetime, you've seen companies come and go. But you've also seen some names on grocery shelves and gas stations and pharmacies that have been there for decades. After big crashes, broad stock markets have historically recovered and, given enough time, hit new highs. It can take years and there are no guarantees, but the general pattern has been panic, collapse, slow healing, new growth. Owning a diversified index fund is like owning tiny pieces of hundreds or thousands of businesses, not betting on one company. In a collapse, the price can drop, but as economies rebuild, productive businesses are usually part of that rebuilding. If you own pieces of them and you can afford to wait, you participate in that recovery. The key phrase there is, if you can afford to wait. This is money you don't need for this year's groceries or next year's medical bills. It's money you can leave alone for many years, even through a storm. That's how stocks survive and even benefit from crises, by being the part of your wealth that can ride out rough seas without you jumping overboard. Asset number 6, high-quality government bonds in the right kinds of crises. In some downturns, when people are scared, they run into government bonds for safety. Prices of those bonds can rise when everything else falls. That's what happened in 2008. Stocks were in free fall, and U.S. Treasury bonds held up or even gained. People were willing to accept lower interest just for the safety of getting their money back. In a deflationary crash, when prices and wages are falling and demand drops, good bonds can be a cushion. They may throw off steady interest and even gain value. But in high inflation or currency collapse, long bonds can lose a lot of purchasing power. If inflation is 10% and your bond pays 3%, you are going backwards in real terms. That's why in inflationary times, people sometimes prefer shorter-term bonds or instruments that adjust with inflation. The practical takeaway for many retirees, having a mix that includes some high-quality bonds, like U.S. Treasuries or strong municipal bonds, can soften the blow when stocks are crashing. In 2008, which would you rather have held? Only bank stocks or a mix of stocks and solid government bonds? I know my answer. So we've talked about things you can buy: land, houses, cash, metals, stocks, bonds. But two of the most powerful assets in any serious crisis are things you can't buy from a broker at all. Asset number 7, practical skills. In every rough period, people who can do real things have bargaining power. The person who can fix a roof, the person who can grow food, the person who can do basic medical care, the person who can repair cars or appliances, the person who understands money and paperwork and can help others navigate systems. For retirees, don't think you're out of this game. Skills like careful budgeting, negotiating with service providers, basic home maintenance, gardening, cooking from scratch, managing your medications and health. These are incredibly valuable if things get tight. If the system got shaky, what skills do you have that others would gladly trade for? Could you help a neighbor with their paperwork in exchange for them helping you with heavy lifting? Could you teach a younger person a trade or a craft? Could you organize a community group to share information and resources? In smaller personal collapses I've seen, job losses, local disasters, the people who had real skills were never completely powerless. They had something to offer besides, "I have money." That's an asset even if it doesn't appear on a statement. Asset number 8, community and family networks. In every true crisis, whether it's a national depression or just a bad season in one person's life, the ones who make it are rarely the lone wolves. They're the ones with family, neighbors, church, or community they can lean on, and who can lean on them. Picture a neighborhood where people know each other. In a bad time, they share food, they share tools, they give each other rides to the doctor, they keep an eye on each other's houses, they watch the grandkids so mom or dad can work a shift. I think back to storms, both literal and economic, where I've watched people in my own life. The folks who had someone to call, someone to knock on their door, someone who would say, "Come stay with us for a while," got through much better than the ones sitting alone with a pile of statements and no one to share the load. If all you build is a big account balance and you never build relationships, you may find that the account isn't enough in a real storm. Money can buy services, but it can't buy genuine care, loyalty, or love. So what do you actually do with these 8 ideas if you're over 50 and planning for the next 20 or 30 years? Let's lay them out clearly in your mind. Productive food sources, whether that's direct ownership of farmland, a small garden, or even exposure through funds. A modest, paid-off primary home, a shelter that doesn't depend on next month's paycheck. Cash and short-term reserves, an emergency fund and some dry powder so you're not forced to sell good assets at bad prices. Precious metals, a modest portion as insurance against certain extreme outcomes. Shares in strong businesses, usually through broad stock index funds that own many essential companies. Quality bonds for cushion in many kinds of downturns, especially deflationary ones. Practical skills, things you can do that others value, especially in tight times. Community and family support, people you can rely on, and who can rely on you. You don't need to own everything on that list to be okay. But ask yourself, where are your gaps? Are you overexposed to just one thing, like a big, expensive house with a huge mortgage and almost no savings? That may be fine in good times, but in a crisis, it can be fragile. Do you have almost no cash because everything is tied up in long-term investments? That looks efficient on paper until you need cash quickly. Do you have some money but no skills or community? If your bank account took a big hit, would you be isolated and helpless or plugged into a network of support? For many retirees, priorities might look something like this. First, secure basic shelter and some emergency cash. That might mean working toward paying off the mortgage on a modest home or downsizing to something more manageable. It also means building or topping up an emergency fund, 3 to 12 months of essential expenses in safe, liquid form. Second, build a reasonable mix of growth, safety, and insurance. Growth often comes from stocks, broad, diversified funds holding strong businesses. Safety comes from cash and high-quality bonds. Insurance against certain disasters might be a small slice of precious metals or other uncorrelated assets. Not all one thing, not all another. Third, invest time in skills and relationships. That might sound soft, but in a real crisis, that's often what keeps people afloat. Learn one small practical skill each year. Deepen one relationship. Re-engage with a community group, a church, a club. The day may come when that asset is worth more than any single stock. We're not talking about panic prepping. We're not digging bunkers in the backyard. This is about resilience, not fear. It's about building a life that is harder to knock over, whatever tomorrow's headlines might be. So let's finish with some concrete steps you can take. First, do an inventory of what you actually have. On a plain sheet of paper, write down your home. Is it paid off? If not, how many years are left? Is it modest for your income, or is it a stretch? Your cash reserves. How much do you have in checking, savings, and safe short-term accounts that you could use in a true emergency? Your investments. Not every holding, but the rough split. How much in stocks or stock funds? How much in bonds or bond funds? How much in anything else? Any precious metals? If you own some, note it. If not, that's fine. This isn't a requirement. Your skills. Yes, write these down too. What can you do well that would be useful if money got tight? Your community. Who could you call, really call, if you were in trouble? Family, friends, neighbors, groups. Write a few names. Second, circle your weakest area. Is it cash? You're one surprise away from real trouble. Is it too much debt? A big mortgage that scares you at night? Is it no skills because you've always outsourced everything? Is it lack of close relationships because you've been so focused on work and money? Third, pick one move for the next 90 days, not 10 moves. 1. Maybe your move is to build or top up your emergency fund. Set aside a fixed amount every month into a savings account, no matter what. Maybe it's to start paying a little extra on your mortgage each month to gently move toward that paid-off home goal. Maybe it's to learn one practical skill, basic home repair, gardening, car maintenance, budgeting, or even how to use your patient portal with your doctor. Maybe it's to join or re-engage with a community group, a church, a volunteer organization, a senior center, a club that meets regularly. Show up 3 times in the next 3 months. Start rebuilding those ties. We are not trying to predict the exact shape or date of the next crisis. None of us can do that. What we are doing is building a life that can take a hit and keep going. You've already survived plenty. Recessions, inflation, personal losses, job changes, family challenges. You are tougher than you think. With the right mix of assets, skills, and people around you, you can face the future with much more calm and much less fear. If this helped you think more clearly about real resilience, not just scary headlines, consider following along here on George Edward Explains. Share this with someone you care about who lies awake worrying about what if. And in the comments, tell me this. Which of these 8 assets is your strongest today, and which one do you want to work on next? I'm George. Thanks for spending this time with me. Take a breath, make your little inventory, pick one step for the next 90 days, and remember, you don't need perfection. You just need to get a few big things roughly right and avoid the worst mistakes.